The broadcast is now starting. All attendees are in listen-only mode.
Okay, we're going to be getting started in 1 minute. Good evening and welcome to the Take Action Partners Discovery Call featuring the Money Max account. My name is Dale Dixon. I'll be your presenter. Just a little bit about myself. I'm a retired Marine, and following the Corps, I went on to retire from Fannie Mae, where I was in charge of diversity and inclusion training for about 10 years. During the same time, I became licensed in life insurance. And following Fannie Mae, I also became licensed in mortgages and real estate. At present, I'm a managing director here with United Financial Freedom, where I've been involved off and on since 2008. And most importantly, I'm currently using the fantastic program that we're going to hear about this evening. And I'm on track to be totally out of debt in 2025. I want you to know that you're in the right place at the right time. The information that you're going to hear this evening can be life-changing, but only if you take action. We're going to talk about a solution to a huge problem, one that has caused people's health to decline, created marital crises and emotional distress, and a variety of other traumatic events in people's lives. That problem, ladies and gentlemen, is debt. Have you ever thought about life in terms of who succeeds and who fails? The Social Security Administration years ago did a study where they tracked 100 people over the course of 40 years. And what they discovered was very sobering. First, at the end of 40 years of work, 54 people were broke. They were dependent on Social Security, relatives, friends, and charity just to make it through the month. Another 36, unfortunately, were dead. They died even before completing the 40 years. 5 needed to continue to work, 4 were financially secure, and only one out of 100, was wealthy. So what does that tell us? Well, the sobering reality is for every 100 people, after working hard for 40 years, only 5% will be financially successful, while 95% will end up dead or dead broke. The question is, which group will you be in? Unfortunately, debt has become the American way of life, and the root cause has to be that there's no financial education in our schools. We have little to no education in schools about personal finance, and yet management of personal finances is critical in every household. There's no wonder finances are a major cause of havoc in our society. It's the number one cause of divorce, and it's the number one cause of personal stress, which leads to medical challenges. So, why isn't personal finance taught in school? Do you think it's by chance, or do you think it's intentional? Whatever the case, here at United Financial Freedom, we're committed to making a difference. And that's why we're here tonight. In America today, debt is at an all-time high. This is true of both our national debt and our consumer debt. Our national debt is over $28 trillion, and our consumer debt is over $14 trillion. The reality is, we've turned into a society where the American way of life is one where we buy things we don't need, with money we don't have to impress people we don't know, resulting in, you've got it, debt. Now, on a brighter note, if you're watching this webinar, you're most likely interested in getting out of debt. You're not alone. The vast majority of Americans are drowning in debt, and yet they don't do anything about it because they don't know where to start. Well, apparently, you're different and inclined to do something about it. You showed up this evening. So, congratulations. Folks, debt is big business. And the truth be told, the less you and I know about how to manage our debt, the more profit the big institutions make off of us. You know, debt is not all bad, and it helps us pay for things we want when we really don't have the money. But that said, debt can cost us our future, especially if we don't understand the difference between good debt and bad debt. You see, good debt puts money in our pockets, while bad debt, on the other hand, takes money out of our pockets. Or if we don't know how to pay off that debt. So if it seems like no matter what you do, you can't make any real progress on your debt, well, it's because the system is set up that way on purpose. Even corporate marketing has jumped on the bandwagon and no longer advertises how much something costs, but rather they talk about how much the minimum payment is. And of course, they're counting on that. You making the minimum monthly payment and them making even more money off of you. If you've done any research, you know the traditional way that we're taught to go about finding relief from debt is to consolidate your debt for a lower monthly payment or refinance to a lower interest rate. And while both of these are reasonable approaches, the reality is that most people, when they do that refinance or consolidate their debt, they continue to pay the minimum monthly payment, simply extending the problem and restarting the clock on the debt. Have you heard of the bi-weekly program? Well, it goes like this. Say you have a long-term monthly debt payment that you're making. You simply agree to send a half payment to the creditor every 2 weeks. So you end up sending an extra month's payment for the year. On average, the bi-weekly payment will shave off about 6 years on a 30-year mortgage. A pretty good result. Maybe you listen to the financial gurus out there. Now, one of them says reduce your standard of living. Eat those ramen noodles. Don't enjoy life. Save every penny you have. And when you get an extra penny, use it to pay down that debt. However, the financial gurus cannot agree on which debt to tackle first. One of the gurus says send any extra money to the debt with the highest interest rate. Another one says, no, no, no. Target the debt with the lowest balance. And once you get it paid off, roll that payment over, adding it to the payment for the debt with the next lowest balance. And repeat the process until all the debts are paid off. Now, this is called the snowball or the debt roll down method. So we have competing financial gurus out there giving conflicting advice. How do you know what to do? How do you know what's right for you in your situation? The reality is, there's only one mathematical equation that leads to the fastest way to pay down the debt. And that mathematical equation is at your fingertips. It is inside the Money Max account system. You see, the Money Max account is not about refinancing. There's no refinance, no debt consolidation, nor negotiation. There's no change to your standard of living, so you don't have to go out there and invest in those ramen noodles. It is not a bi-weekly payment. It's not a debt roll down plan. It's not even a concept or theory. So let's talk about what it is. It's a web-based financial GPS. This system looks at money coming in and money going out. It looks at all the variables based on the timing and movement of household cash flow, as well as all the variables associated with debt. It identifies that one mathematical solution for you to pay off your debt fastest. It then shows you step by step, turn by turn, exactly how to become debt free in the shortest time possible. It is an individualized plan for your unique situation. No one size fits all. It will look at your current debt and allow you to forecast and plan for any future debts, like a new car purchase or putting a new roof on the house. The Money Max account has a proven 15-year history, and it has helped our customers pay down well over $2 billion in principal. It removes all the guesswork from the equation. It's not based on magic, but rather it's based on math. And most important, it directs you to send the right amount to the right debt at the right time. Now, let's take a look at an amortization schedule. And let's look at what is most likely your largest debt. For homeowners, your largest debt is likely your mortgage. This particular amortization schedule is for a $300,000 mortgage at 4% interest with a monthly payment of $1,432.25. For illustrative purposes and simplicity, we'll round down to the nearest dollar. So a payment of $1,432, payable over 30 years. Now, this is the amortization schedule for that mortgage. And let's just imagine that this is your mortgage. You will notice that at the end of year one, 69% of your payments went to interest. Now remember, this mortgage supposedly has a 4% interest rate, right? Right. Now let's fast forward to year five. Over 63% of your payments went to interest. Fast forward again to year 10, and over 55% is going to interest. And lastly, to year 15, where we can see that over 46% of all payments went to interest. There's got to be a better way, folks. And you know what? There is. So how do the banks get away with it, claiming this mortgage has a 4% interest rate when so much more of the payments is going to interest? Now let's look at the actual breakdown of that payment. The monthly payment is $1,432. That's $432 to principal, while $1,000 goes to interest. That means that 70% of your payments went to interest. That also means a 70% profit to the banks. Now you're on a roll in month two, as a whopping $2 more goes to principal. You now have $434 going to principal and $998 going to interest. And by year five, over $85,000 has been paid, but only $28,000 went to principal. That's over $57,000 to interest, double the amount that went to principal. Now, many people will refinance their mortgage between years 5 and 7. This means that they are resetting the mortgage back to the start and throwing away all the interest that they already paid. So how long does it take to get halfway through this mortgage? You'd think it would be 15 years, right? Since it is a 30-year mortgage. Well, in this scenario, with a 4% interest rate, it takes 19 years and 3 months to get to the halfway mark. You have now paid over $330,000 in monthly payments, and your remaining balance is still $149,966. You're only now at the halfway mark. Remember, the original mortgage amount was $300,000. You're going to end up paying $515,000 over the life of the mortgage. That is $215,000 over and above the original mortgage. It represents 72% of the original mortgage that you are paying in interest, that you are handing over to the bank when you borrowed just $300,000. So, how can we accelerate this amortization schedule? Well, let's break it down. And let's say you just got a new mortgage for $300,000 at 4% interest, and you haven't even made the first payment yet. See how it's broken down with $1,000 going to interest that first month and $432 going to principal? Let's play a little game of what if. What if you can afford to pay all of these principal amounts up front? If you add it all up, it totals $2,615. Now, I understand that most people don't have an extra $2,600 just laying around, but we're just playing a game of what if. Now, the way the amortization schedule works is anytime you pay the monthly principal amount in advance of when it is due, it automatically cancels the corresponding interest amount. Therefore, that one time investment of $2,615 just saved you $5,979 off the back end of the mortgage. That's a 128% return on investment. Wow! So why don't we do this more often? Well, because most people don't have an extra $2,600 just laying around. Now, our program does not create money out of thin air. However, it is a powerful system, and we're going to review very quickly some of the strategies under the hood of that system. And hopefully, you'll start to understand just how awesome it truly is. Now, our system is about making sure that every single penny, nickel, dime, quarter, or dollar that you make is either canceling interest or earning interest. Our program combines banking strategies with advanced math and innovative technologies to make sure that your money starts to bank like a bank. And it's about turning around those rules of banking in your favor so that you can pay off that debt as quickly as possible, save as much money in interest as possible. Now, there are just four requirements to use our system. You need debt, which most people have. You need a checking account, you need a savings account, and you need the secret sauce, the Money Max Account program. Now, there's also the option of using a line of credit. It can be a home equity line of credit, a personal line of credit, or even a business line of credit. Any of these can be used in place of a checking and savings account. The advantage is negligible, however, and my understanding is that by using a line of credit, it would only reduce the total payoff time by about 2 to 3 months. At this point, I would like to interject that as of November of last year, we have a new version of the Money Max account, and it's called the Money Max Account Pro or MMA Pro. The MMA Pro entails the addition of a third engine to drive our software's capability. Remember, the first two engines are checking and savings and advanced line of credit. The third and ultimate engine we refer to as the Wealth Builder account. Suffice it to say, the Wealth Builder account is awesome. I'll leave it at that for now, but there's much, much more to come. Now, let's take a closer look at our system, how our system works. And if we just use checking and savings like 70% of our clients do. You see, our system is based on a lot of different money saving strategies, but we're only going to talk about four of them here. Interest accumulation, interest float, interest cancellation, and strategic payoff. Let's look at one possible scenario. Introducing John and Rebecca Jones, who have $5,000 of monthly household income, $4,800 of monthly expenses on average, and about $200 left over at the end of the month. We call this discretionary income. Of course, sometimes the expenses are more and sometimes they're less. We're going to target one debt right now, keeping things nice and simple. So we have one mortgage with a $200,000 balance and a 6% interest rate. The monthly payment is $1,199.10, and the term is 30 years. And since we want to practice a little bit of interest float, we're going to include a credit card with a zero balance, a 12% interest rate, and a 20-year term. Now, this part is optional. However, we want to show you how the interest float strategy can be used with our system. Now, in month number one, John and Rebecca's paychecks come in totaling $5,000. Again, the system looks at money coming in and money going out. The goal is the mathematically most efficient way to pay down the debt. The system says, you know what? Let's not have this money just sitting in your checking account. Let's move it over to your savings account. So John moves the $5,000 from checking to savings, where it can start to accrue interest. In the meantime, John and Rebecca are going to put everything on the credit card. And they're going to practice interest float. All $4,800 of their monthly expenses are put on the credit card over the course of the month. That includes their mortgage payment, auto expenses, groceries, utilities, etc. Now we know that not all bills can be paid with a credit card, but this is strictly for the purpose of illustrating the strategy. After making the monthly mortgage payment of $1,199, the mortgage balance only decreases by $199. And their $5,000 of monthly income was allowed to set in their savings account all month and accrue interest. They earned $8 at 2% interest. It's not a lot, but it's an example of some interest accumulation. Now, in month number 2, the $5,000 of household income is again deposited in checking. Quick question. If you start out with a $0 balance on a credit card and you put debt on that card over the course of the month, and then you pay that card off in full at the end of the month, how much interest accrued? Well, the answer is 0. And that's called interest float. John and Rebecca have allowed themselves to borrow money at 0% interest for 30 days while their money was in their savings account, accruing interest for 30 days. Now the system says, let's go ahead and pay off that credit card in full. So they send $4,800 from checking to the credit card, paying it off in full. Then the system says, hey, you're paying a lot of interest on that mortgage. Let's start paying it down. It tells them to move $3,789 from savings to checking. Now the system tells them to take $3,989 from checking and make a principal only payment to their mortgage. They are now canceling interest on their mortgage. That one payment of $3,989 eliminated 16 payments, saving them $18,746. That's a substantial amount of interest cancellation, and this is only month number 2. Now, you might be thinking, but they still have to live. How do they live with 0 in their checking? Remember, they're still putting everything on their credit card, and they will pay it off in full at the end of the next month before the payment due date. So no worries at all. So let's do a recap. In this scenario, we had a $199,000 balance at the beginning of month number 2. After we made that additional payment of $3,989, the balance was reduced to $195,000 by the end of month 2. Check out our before and after. Before, we had 358 payments remaining after month number 2. But after applying the Money Max account, we only have 342 payments remaining. We eliminated 16 payments by that one transfer of money. And originally, we were scheduled to pay $231,677 in interest over the life of the mortgage. Now, that amount has been reduced to just $212,931. We just wiped out $18,746 in interest. You applied just $3,989 and got back $18,746 in savings. Folks, that's a 369% return on investment. That is money that you will not have to pay the bank. It's canceled forever. Now, let's look at a side-by-side comparison. A conventional bank program versus the Money Max account, and a $200,000 mortgage. Now, in 1 year, based on the bank schedule, this person would have a balance of $197,000. However, using the Money Max account, their balance is down to $184,000. Following the bank schedule, that would have taken 5.5 years. And of course, the total repayment time, according to the bank schedule, is 30 years, while our program would have the loan paid off in just 10.4 years. And instead of paying over $231,000 in interest, according to the bank schedule, our system would have you paying only $70,000 in interest. That is a total interest savings of over $167,000. Can you imagine what you could do with an extra $167,000 in your bank account? Again, everybody's situation is different, but this side by side comparison is an example of how powerful our system can be when it comes to paying off debt and saving money that would have otherwise been spent on interest. And when you think about the fact that people are living longer today and most are more worried about outliving their money than dying, imagine how life changing it would be to be totally out of debt in the next 5 to 7 years, own your home outright, and free to redirect monies previously earmarked for paying monthly debt to your own future retirement savings. Wow. Now, most people don't have just one debt, but they have multiple debts. And when you look at multiple debts, it can be mind-boggling to choose which debts to target or pay off first. Remember when we talked about the financial guru's advice a little earlier in the presentation? Even they don't agree on which debt to tackle first. We started with the mortgage at $200,000 and 6% interest. But what if you had a student loan at 7% interest and an auto loan at 7.25% interest? Maybe you bought some furniture for that new house at 7.125% interest. And don't forget about the credit card. In this situation, which debt would you pay off and why? The more debt we have, folks, the more payoff options there are to choose from. How do you know you're choosing the right one? The term for what we are discussing here is strategic payoff. And the reality is, the wrong decision is going to cost you time and money. You might be wondering why you can't just make additional principal payments yourself. Well, unfortunately, it is far more complicated than that. You see, according to FICO, the Fair Isaac Company, the average person has 13 active creditors. That means that every single month there are over 6 billion different strategies. That's over 6 billion different potential combinations of ways to pay off that debt. So, what is the likelihood that you will make the right decision every single time? As a matter of fact, it is highly unlikely. And it's more likely that you will make the wrong decision most of the time. So why not just eliminate that glaring inefficiency in exchange for peace of mind? Why not just use the Money Max account? Well, folks, it should come as no surprise that a powerful program like the Money Max account has been featured in a variety of nationally syndicated magazines as well as on radio and TV. But you know, in all likelihood, the best national recognition we could possibly have gotten was from Ernst & Young. You see, Ernst & Young came knocking on our door back in 2008 and did some intensive due diligence. They are actually responsible for auditing publicly traded companies and doing what is right for the consumer. They're in charge of consumer oversight protection. So when they came to our doors, they wanted to investigate and ensure that our company is doing everything that we say we're doing. They went through our financials with a fine-tooth comb. They sat down with our executive team and they had their financial planners and accountants scour through our program. And after their extensive and intensive due diligence, not only did they find that we are a debt-free company that practices what we preach, they also found that our executive team is second to none and our customer service is exceptional. The fir- they further found that we are, in fact, doing what we say we're doing. We are consistently helping our customers pay off their loans in as little as a third to one half the scheduled time. And they were so impressed by us, they awarded us the Ernst & Young Entrepreneur of the Year Award for 2008 in the Utah Region Financial Services Division. Now, this is a similar award as was received by, and you may recognize a few of these names, Apple, Starbucks, eBay, Microsoft, and many other companies that are nationally recognized for excellence. At the end of the day, the true strength of our program is all about our financial GPS. Have you ever used the GPS in your car to get where you want to go? I mean, isn't it like the ninth wonder of the world? I mean, it's right up there next to compound interest. Would you agree? And most people have one. You just put in the address where you want to go, and the GPS gives you turn by turn directions. Imagine having that type of technology for your finances. That's what we provide. You simply tell the system how much you owe for how long, what is your interest rate, and what type of interest, fixed, adjustable. Tell it about your income, how many, how often, how much. Is it commission based, etc. What's coming down the road? Things like vacation or a new car purchase or some other major purchase. And when those unexpected expenses happen, which I call life, you simply tell the system and it will, you got it, recalculate. Now let's compare our financial navigation system to the GPS in your car. You see, just like the GPS in your car guides you to make all the turns, the MMA guides you to pay off all your debts. And just like the GPS in your car takes away the stress of deciding which route to take when obstacles arise, the MMA takes away the stress when complicated financial decisions come up. Your GPS in the car helps keep you focused. So does our MMA. It helps you stay focused on your financial plan, your roadmap to becoming debt free. The GPS in your car tracks your success as you follow the route. So does our system. It tracks your success as you follow the program. And lastly, just like your car's GPS gives you the time that you will arrive at your destination, our system tells you the date, month, and year you will be debt free. The Money Max account, folks, is math. It's all about the math. And here's some good news. The time it takes for you to update the system can be done in as little as 20 minutes per month. But I want to caution you, you might elect to spend more time. I certainly do, because it's exhilarating, and I always find it to be time well spent. Here at United Financial Freedom, we say that the results speak for themselves. To date, we have helped our clients pay down well over $2 billion of principal. I didn't say interest savings, I said principal. The reality is, no matter what your financial goals, the only way you can achieve them is to eliminate debt. Debt is, bar none, the single greatest hindrance to your financial future. It is critical to remove debt from the equation. Would you believe that for the average person, 39 cents of every dollar earned goes to paying interest on debt? You heard that correctly, 39 cents for every dollar. Now, can you imagine getting a 39% raise? Folks, I'm talking no additional work, without having to work harder, without working longer hours, just by getting rid of the debt. The average person would realize a 39% increase in quality of life. I submit to you that that is huge. Well, as we begin our wrap up, I'm asked all the time, will this system work for me? And the truth of the matter is, I don't know. But it is time to find out. And the best thing you can do right now is get back with the United Financial Freedom agent who invited you and get your free savings report. If you were invited by email or Facebook, go back to the invite and get the contact information for your agent. The savings report will let you know the precise month and year that you can become debt free using the Money Max account. Well, folks, we have reached the end. I want to congratulate you for taking the first step towards becoming debt free by attending this webinar. It has been my profound pleasure to be your host, and I'd like to leave you with this thought. The only difference between where you are and where you want to be is the steps that you haven't taken yet. Again, this has been Dale Dix of Take Action Partners, urging you to take action now. Thanks again for joining us. I wish you all an enjoyable rest of your evening.